Now, a qualifying relative cannot be a qualifying child as well. So if they're not a qualifying child, that would be the first test one might take. Then the second test would be to determine whether or not this person may be a qualifying relative. There is an additional tests, however, that must be met, and this is the gross income test. Generally, they'll compare that to the exemption amount, and the support test. How much of the support are they providing? More than half the support. This is a breakdown then of the standard deduction available, and this is, of course, available for those who take the standard deduction. If you itemize, if you decide that your itemized deductions allowing for the adjusted gross income thresholds, if you do itemize, then you may not use Form 1040A, and certainly not Form 1040EZ from the previous chapter. You would have to file Form 1040 and complete Schedule A. So assuming you do take the standard deduction, however, on Form 1040A, then these are the amounts of those standard deductions. And this year it's $6,350 in 2017. It's double that for married filing jointly. Filing separately, the benefit is only as though a person were filing, each spouse were filing as a single person. So there's no bump or increase in the the standard deduction by married filing separately. Head of household, there is an advantage over the single filing in terms of the standard deduction. And the thinking, I think, here is that the head of household is providing more than half the support for a dependent, and is therefore entitled to a greater deduction here. And then we talked about earlier the qualifying widow or widower. This filing status is available for years 1 and 2 after the year of death, providing that the surviving spouse is providing more than half the support for adopted or a biological child. There is an addition to the standard deduction for people who are age 65 or older or blind. If the person is blind, they don't need to be 65 to qualify for this supplement to the standard deduction. And we'll talk about that, the supplement amounts, in a minute. Also, the standard deduction is limited for dependent taxpayers to $1,050 or the taxpayer's earned income. And I want to emphasize that in some of the problems, for example, in the text, they will provide income like interest income in addition to earned income and ask you to determine what the dependent taxpayer's standard deduction is. Only include, please, the earned income. So the earned income is generally from a job or employment, wages and salaries. So you would take the amount of wages and salaries, add $350, and then you would compare that to $1,050 and take the larger of the two. And that would be the standard deduction for that dependent. The amount, of course, cannot be greater than the $6,350 standard deduction. Now, just to kind of clarify things a little bit, these thresholds relate to the standard deduction. So this is a person, generally a child, who is being claimed as a dependent by another taxpayer, generally the parents, but they're still, if they have a part-time job, they're still entitled to a part or all of the standard deduction, even though they can't take the personal exemption for themselves because their parents are doing that. And these are, as I mentioned earlier, the supplements that are available for taxpayers who are 65 or older or blind. So if a person is single, they'll get an additional $1,550 onto their standard deduction. Married filing jointly, the amount is not as great. The amount is only $1,250. We had a discussion, I thought a really good discussion in class about this. Why would it be that the married filing joint return supplement would be less than the single supplement? And some of the insights shared in class from some of the students suggested that, well, the married filing jointly person would have somebody else. So if they're older, they may have someone else to help take care of them. A single person would not have that advantage, of course. And the same is true of being blind. Right? If you're married filing jointly, unless both spouses are blind, then the other one spouse who is able to see would be able to help the other spouse, and therefore the additional supplement to the standard deduction would be less. Head of household is the same as single, and qualifying widower is treated as married filing joint. We talked a little bit earlier about the formula for determining what is our tax obligation and whether or not we're entitled to a refund or if we're going to have to pay into the government. And so, as I said earlier, if your income is $100,000 or less, you can use the tax tables. Otherwise, we must use the tax rate schedules, and those are in the appendices in the back of the book, as well as online. And tax payments, or the credits I mentioned earlier, are a dollar for dollar reduction. The credits are, are a dollar for dollar reduction in the amount that we owe. And we'll talk more, as I said in Chapter 9, about which credits are refundable and which cannot create a refund. I mentioned earlier the earned income credit can create a refund, but we'll talk about others in Chapter 9. Also, withholding by the employer generally means that as you are earning your money and receiving paychecks and have federal taxes withheld, generally if you have the W-4 filled out properly, that you are having the amount withheld that would get you close to your tax liability. If, however, a person retires and nobody is withholding taxes anymore from their retirement income, then generally the folks who are retired would need to start making quarterly payments so they do not owe too much in taxes when they file their taxes and may be subject to penalties and interest. So folks who are not having taxes withheld from income generally must file quarterly reports, as well as people who even maybe are working but have a high investment income. And again, that may create a real tax liability when they file their taxes the following winter and spring. So it's best to anticipate the amount of your tax liability and be sure that enough is periodically paid to the IRS through the tax year, so that a large deficit or amount owing is not present when you file your taxes. I wanted just to run back to the tax return here for a minute. I mentioned earlier on line 7 of Form 1040A, you would include the wages, salaries, and tips from W-2s. Interest, of course, any interest is added. Talked about tax-exempt interest, for example, from municipal bonds. More of these, we haven't gotten to some of these other items yet, like unemployment and IRAs. We'll talk more about those in the weeks ahead. In any event, at the end of the first page of Form 1040A, line 21, you would have that all-important adjusted gross income number, which is transferred to line 22. And then proceed with, in this case, the only option on Form 1040A is the standard deduction. To the margin here, these are the standard deduction amounts we talked about earlier. And of course, their basis we set on the filing status. In this case, in this particular example, they had one child under 17. Therefore, they're entitled as of 2017 to a $1,000 tax credit. That tax credit comes off of the tax liability, so the tax liability was calculated based upon the taxable income that you see here on the screen. Since it was $52,250 as taxable income, we were able to use the tax tables. We could have used a tax schedule, and the amounts of tax owing would have been pretty close. All right, so once you then calculate your tax obligation, deduct your credit, in this case for the child tax credit, you wind up with your total tax. Your total tax then is the final amount of your tax liability to the IRS, the Department of Treasury, for the year 2017. You will then compare the amount you owe, your liability, with the amount you paid throughout the year. And in this case, we have quite a disparity. We have $3,901 we overpaid, which is quite a bit. And to put that in context, you could take the $3,901 and divide that into the $5,909. And that's 66% of the amount owed will be coming back as a refund. That's quite substantial. All right, and then finally, the amount you overpaid is generally the amount to be refunded, unless you wish to have part of that apply to your future tax obligations. All right, so that's a brief overview then of Form 1040A. We will discuss in the weeks ahead then, as I mentioned earlier, we'll discuss other of the line items that we didn't discuss, especially on Form 1040 in this chapter. Wanted just to mention in closing that there's more information in the chapter regarding tax penalties, but I would read carefully the tax penalties. It came up in class last night, asking how long should we keep our tax forms? And in terms of keeping our tax forms, I'm just going to go back to here. In terms of keeping the tax forms, generally we should keep them in perpetuity, because there is no statute of limitations regarding the filing of a tax return. So we always need to be able to prove that we filed a tax return in the event the IRS ever asserts that we did not file a tax return. So there is no statute of limitations there, and so we need to always be prepared to provide evidence that we did file a tax return in any given year. In terms of an accuracy-related error, if the IRS asserts that we made an accuracy-related error or a disclosure error that was not the result of fraud, the IRS generally has 3 years to make that assertion and to notify the taxpayer, unless there's fraud involved. And if there is fraud involved, then the IRS has 6 years. So for accuracy-related errors and fraud, 3 to 6 years, we should hold our records. But in terms of being able to prove that we filed a tax return, which is very serious, if a person does not file a tax return in any year when they are required to, that can result in a significant, not only civil penalty, but also a criminal penalty. And you can fill in some of the details as you review the chapters on what those penalties are. So I hope you enjoy chapter 2. Please let me know if you